Welcome to the Deep Dive, where we cut through the noise of earnings calls to bring you the most critical insights. Today, we're unpacking Intapp's Q4 and full fiscal year 2025 results. And let me tell you, this report offers a pretty fascinating look at a company executing a very targeted strategy.
It really does. We've seen a robust performance that clearly resonated with the market, definitely. But there's also a nuanced outlook that deserves a closer look.
Exactly. Our mission today is to get past those headlines, then dive deep into the strategic drivers. Things like their cutting-edge AI initiatives, the huge impact of their partnerships, and how they're strategically positioning themselves in the whole professional services landscape. We want to give you the why behind the numbers.
And we'll definitely look at the immediate market reaction, sure, but maybe more importantly, the broader implications for Intapp in the vertical SaaS space. What did analysts actually think and what really moved the needle on that positive sentiment?
Okay, so let's jump straight into the numbers for Intapp's Q4 FY25. They delivered a strong beat on both the top and bottom lines, non-GAAP EPS, which, gives us that clearer picture of core profitability.
Right, excluding the one-offs.
Exactly. It came in at an impressive $1.27. That handily surpassed the $1.23 consensus estimate.
That's a solid beat.
And total revenue hit $135.0 million. That's an 18% year-over-year increase, also beating the roughly $132.1 million consensus. So yeah, solid beats all around.
They absolutely are. And, a significant driver of that revenue growth was their SaaS segment. That saw a 27% year-over-year increase, hitting $90.2 million.
Wow.
But the real story, I think, is their cloud annual recurring revenue, or ARR.
Predictable revenue stream.
Exactly. The predictable recurring stuff from their cloud software, that grew an impressive 29% year-over-year to $383.1 million.
Almost 30%.
Yeah, and what's particularly notable here is that cloud now represents 79% of their total ARR. I mean, this isn't just growth. It's a really profound strategic pivot. They're basically telling the market they're a dominant cloud-first player now.
Right. In an industry that was historically pretty on-premise heavy.
Precisely. That's a powerful signal.
And looking at the full fiscal year 2025, Intapp crossed some, truly significant milestones. Total revenue reached $504.1 million, up 17% year over year.
$500 million.
Their non-GAAP operating income nearly doubled to $75.6 million. That's a powerful indicator of, scaling profitability.
Huge jump there.
And free cash flow exceeded $100 million, landing at $121.9 million. I mean, these numbers, they paint a picture of strong operational efficiency and a successful shift towards, let's say, more profitable growth.
The market certainly took notice. The immediate response was notably positive. Shares saw a double-digit increase right after the report.
I saw that.
So it suggests investors were really laser-focused on these strong beats and the strategic signals, particularly that shift to cloud and maybe the share repurchase announcement too.
Okay, so we've got the strong financial picture. Now let's unpack the how. What's driving all this? Maybe start with their applied AI strategy. In a world just awash with AI buzzwords, what specifically makes Intapp's approach stand out? Why is it resonating so much?
Well, what's fascinating here is how Intapp is applying AI. It's directly aimed at the specialized, often really complex needs of markets like legal and private capital.
Right.
It's not just a buzzword for them. It's about solving very specific real-world problems. They've launched solutions like Intapp Deal Cloud Activator for BD.
This development, yes.
Intapp Assist for Deal Cloud with features like origination recommendations, smart tagging, helping firms actually find and win new business.
Okay.
For legal pros, there's Intapp Assist for Terms, which helps with client compliance, and Intapp Walls for AI, for crucial data protection. They even rolled out the next gen of Intapp Intake, featuring AI-powered summaries and data integration.
Yeah.
It's all about practical, down-to-earth application.
And the adoption numbers really seem to tell that story. We heard Assist for Deal Cloud now accounts for, roughly 35% of new Deal Cloud wins?
Yeah.
Which is a massive jump from just 8% last year. That's a really clear indicator of client traction, isn't it? Clients are actively choosing these features.
Precisely. And management highlighted some compelling client wins that really illustrate this, like an international law firm successfully using Intapp Assist for AML regulations in Australia anti-money laundering.
Complex stuff.
Right, demonstrating how compliant AI is crucial for navigating these tricky global regulatory landscapes. And Pantheon Ventures, a big global private equity firm, they replaced a legacy system with Deal Cloud and Intapp Assist. Why? To improve deal flow, capture more opportunities, bring AI right into their workflows.
So it's helping them actually make more money, basically.
Exactly. It shows how AI is helping these firms not just be more efficient, but originate and win more business, onboard clients faster, get insights from their own proprietary data, all while sticking to those stringent compliance rules. It's becoming indispensable for them.
Okay, so we've seen how their AI is hitting home directly with clients, but what about the wider ecosystem? This leads us to another really fascinating aspect, Upton, their strategic partnerships. How much are these influencing Intapp's success, especially with their biggest clients?
Oh, hugely. If we connect this to the bigger picture, these strategic partnerships are a critical growth driver for Intapp. They're significantly contributing to their largest deals and really accelerating time to value for clients.
Right.
In Q4, partners were directly involved in a staggering 17 out of their 20 largest deals.
17 out of 20?
Yeah. And partner influence bookings grew more than 50% year over year. So this isn't just, partnerships are nice to have. It fundamentally redefines Intapp's go-to-market. Partners aren't just facilitators anymore. They're becoming like the primary sales engine for Intapp's most valuable, most complex deals.
And Microsoft really seems to stand out here. Looks like a cornerstone of that strategy.
Absolutely. The Microsoft partnership was cited as a major success, driving almost half of those largest Q4 wins.
Wow, nearly half.
And what's particularly powerful about this, I think, is that Microsoft's support actually extends to fronting Azure investment dollars for deals.
Oh, interesting.
Yeah, and allowing clients to leverage their existing MAE agreements, that's Microsoft Azure Consumption Agreements, to purchase Intapp solutions.
So it makes the buying process way easier.
Exactly. It dramatically streamlines the sales process and simplifies budgeting for clients. It just removes potential friction from those big enterprise deals. It's a, win-win.
And beyond Microsoft, they also highlighted other key partnerships. Snowflake, I saw.
Yep, Snowflake. That's an expanded collaboration for building analytics across firm-wide data, leveraging the Snowflake AI Data Cloud, and a new partnership with MSCI, which provides access to private capital, real asset, and deal data directly within Intapp Deal Cloud.
So these are clearly targeting very specific, high-value data needs for their clients, aren't they? Making the platform stickier.
They are, absolutely. And this raises an important question, right? How are they expanding their client base and improving engagement beyond just bringing in new logos?
Good point.
Well, they are consistently growing existing accounts through cross-sell and upsell, obviously, and migrating more clients to the cloud. The numbers here are pretty compelling. The number of clients with over $1 million in ARR grew 49% year over year.
Almost 50% growth in those big accounts.
To 109 clients now. And their cloud net revenue retention rate, NRR, stands at a very healthy 120%.
Which means existing cloud clients are spending 20% more on average year over year.
Exactly. So they're not just acquiring new clients, they're successfully deepening those relationships and significantly increasing revenue from their current cloud customer base. That's a powerful engine for growth.
Okay, so beyond just growing their core business and these crucial partnerships, Intapp also made a notable acquisition. They brought TermSheet into the fold back in Q3. What was the strategic thinking behind that move, especially thinking long-term?
Right, the TermSheet acquisition, it was $51 million cash with potential additional earnouts. And the strategy was really about expanding capabilities in the real assets market, specifically for asset management after fund deployment.
Okay, so post-deal management.
Exactly. Now, its ARR contribution in Q4 was frankly pretty immaterial, less than 5% of incremental ARR. But management views it as a significant long-term market expansion opportunity.
So more about the future potential.
Definitely. And perhaps just as importantly, it brought a very strong AI-first team into Intapp, which bolsters their engineering capabilities and their whole AI roadmap. It's less about immediate revenue, much more about foundational future growth in a, specialized underserved vertical.
Got it. So looking ahead then, what's Intapp's guidance for fiscal year 2026? It's always important to see what management is actually projecting.
Okay, for the full fiscal year 2026, they project SaaS revenue between $411.4 million and $415.4 million, and total revenue between $566.7 million and $570.7 million. Non-GAAP operating income is expected to be between $96 million and $100 million.
Okay, pushing towards that $100 million mark.
Right, with non-GAAP EPS projected at $1.09 to $1.13. So these numbers suggest, continued strong growth and definitely increasing profitability.
And for Q1 FY26, the immediate next quarter, we're seeing some interesting notes. Gives us a glimpse into their near-term strategy, maybe a bit of nuance to that overall bullish picture.
Yes, exactly. The Q1 guidance anticipates SaaS revenue of $95.7 billion to $96.7 billion and total revenue of $134.8 million to $135.8 million.
But the non-GAAP operating income is guided lower, between $60 million and $17 million.
Lower margin near term. Why is that?
Well, this Q1 outlook specifically includes some front-end spending. It's related to go-to-market initiatives, things like a sales kickoff, targeted marketing investments.
Investing for growth.
Right. It suggests an intentional strategic investment that will impact the near-term margin, but it's designed to fuel future, hopefully higher, growth down the line.
Okay, that makes sense. So given these projections and the new share repurchase program they announced, what does this all tell us about their capital allocation priorities? Where's the money going?
Well, management clearly prioritizes continued investment in its product roadmap, especially in AI development. That's number one. And they're actively considering strategic acquisitions like TermSheet that fit their growth profile.
But the board also authorized a $150 million share repurchase program. And management framed this as an explicit signal to offset dilution, support EPS, and free cash flow per share. Basically allowing them to opportunistically deploy capital to enhance shareholder value.
So it's a balanced approach, then, investing in aggressive growth, but also returning capital and managing dilution.
Yeah, exactly. That seems to be the plan.
So despite that, let's call it softer Q1 operating income guide due to the spending, it seems investors really prioritized those strong immediate results, the beats and the buyback. They signaled confidence in the long-term story. But what was the broader feeling from analysts beyond just the share price jump?
That's right. And the sentiment is, I'd say, generally constructive, reflecting the strong beats on revenue and EPS combined with that buyback announcement.
Okay.
However, it's not exactly euphoric. Some analysts, like Oppenheimer and Raymond James, they maintained market perform ratings. They noted maybe a smaller than usual beat this time and that softer Q1 operating income guide. But they still acknowledged the record net new ARR and the clear FY26 growth drivers.
So acknowledging the positives, but maybe tempering expectations slightly.
Kind of. Then you had Truist, conversely, maintaining a buy rating. They specifically highlighted the success of those partner-assisted wins we talked about and the strong SaaS growth outlook. So this mixed analyst sentiment, it indicates a careful weighing of the short-term investments against those longer-term strategic advantages.
And this ties directly into the broader macro picture, right? Intapp operates in vertical SaaS for professional services. That's generally seen as a pretty durable end market.
Very durable. It's benefiting from ongoing digitalization, the big push to the cloud, and increasing compliance demand. Their vertical-specific AI offerings are a really strong differentiator in these highly regulated environments.
Right. And you mentioned compliance. It sounds like regulatory changes are actually tailwinds for them, not hurdles.
Absolutely. And here's where it gets really interesting. Regulatory shifts, like the upcoming QC 1000 accounting change. That's a big one for professional services firms.
Mandating significant reporting changes.
Right. And enhanced anti-money laundering, AML regulations, demanding much more rigorous client vetting. These are seen as significant opportunities for Intapp. They actively drive demand for their specialized compliance solutions because their deep understanding of these complex workflows is a key differentiator. Firms need help navigating this stuff.
So regulation actually helps their business case.
Exactly. However, the broader software spending normalization across the industry and that margin cadence we talked about for Q1, those remain watch items over the next 1 or 2 quarters. So there are still broader market factors to keep an eye on.
Okay, makes sense. All right, this is the part of the deep dive where we put on our most outrageous but plausible trade idea hats. And remember, everyone, this is absolutely not financial advice, just some food for thought, like you're pitching an idea to an investment committee.
Okay. All right. Given Intapp's unique position, here's an idea. A long-term bullish play on Intapp. Specifically, let's call it a compliance AI supercycle trade.
Intriguing. Okay, lay it on us. What does that actually look like, and what's the core thesis behind it?
Well, the trade could be something like buying Intapp stock, maybe pairing it with some long-dated call options for leverage. The thesis is this. The market is currently underestimating the compounding effect of Intapp's vertical-specific AI capabilities, particularly around compliance.
Underestimating the compliance angle.
Yeah. Regulatory changes like QC 1000, enhanced AML rules. These aren't just nice tailwinds. They are creating arguably a mandatory upgrade cycle for professional services firms. They need to stay ahead of increasingly complex global requirements.
So it becomes non-discretionary spending for them.
Yeah, potentially, yes. And Intapp, With its deep domain expertise and those compliant AI solutions built right into the workflows these firms already use. They're uniquely positioned to capture this massive demand. Plus, that Microsoft partnership we discussed, leveraging existing MSCI agreements, that drastically reduces sales friction for these mission-critical AI-powered solutions. Makes it easier for firms to say yes.
So you're betting on the stickiness and, frankly, the absolute necessity of their AI-powered compliance tools. You're arguing firms basically have to adopt these solutions to operate effectively and compliantly today. But what about the cost? Isn't there always a budget hesitation, especially with that Q1 spending impacting margins?
That's a crucial question, yeah. And while the Q1 guidance does include that front-end spending and that slight dip in operating income, I'd argue this is an intentional investment. They're investing now to capture what could be a multi-year supercycle of regulatory-driven AI adoption. And it's happening in an underserved, highly profitable niche.
So the investment now pays off bigger later.
That's the bet. Firms aren't just buying a nice-to-have feature here. They're investing in survival and competitive advantage in a super complex regulatory world. The share buyback provides a bit of a floor, shows management's commitment to value. But the real upside, the thesis argues, comes from these firms being essentially compelled to adopt Intapp's solutions. It's a bet on, regulatory inevitability meeting cutting-edge, verticalized AI. That could drive a sustained demand curve that surprises to the upside longer term, making that Q1 investment look pretty smart in hindsight.
That was a deep dive into Intapp's latest earnings. They delivered strong Q4 and full-year results, really driven by impressive growth in their cloud offerings, that aggressive AI integration, and a very powerful partner ecosystem.
Indeed. And while Q1 includes some of those front-end investments aimed at driving future growth, the overall outlook for FY26 definitely points to continued profitable expansion. It's fueled by their focused strategy on vertical SaaS for professional services and those tailwinds of digitalization and increasing compliance demand. It's a compelling story in a very specialized market.
It's a truly interesting look at a company executing a really targeted strategy in a very specific high-value market. We hope this has given you some valuable insights to consider for your own analysis. Now, here's something to think about. If Intapp's AI-powered compliance solutions do become the default standard for major professional services firms globally, what does that imply for their long-term competitive moat? And maybe, what are the next unserved, highly regulated industries they could potentially target and dominate?
And just a reminder, everything we discussed today is for informational purposes only. It should absolutely not be taken as financial advice. We always encourage you to do your own diligence and research.
Thank you for tuning in to The Deep Dive. We'll be back soon with another earnings call review.